Hello and welcome to another episode of Brew Time with me, Vincent Hung. Now, my choice of beverage might be a bit strange today. That's because unfortunately I contracted COVID and I have to self-isolate. This also explains my hat because I haven't been able to go to the hairdressers. Now, instead of me moping, let's carry on with the video. So the reason why I made this video is because I often ask myself, what should I do with my hard-earned money? Now, it's not to say that I earn a lot, it's just that I don't really need to spend a lot to make myself happy. But the answer to this question isn't as clear-cut, and it has changed over time. This is why I need to share a few snippets within my life story with you. So to start off with, back when my wife or girlfriend at the time moved back to the UK, my goal was clear. I needed to save. I needed to save a deposit so that we could buy our own home. At the time, I was living with my parents, so we were definitely motivated to save as much as we could. Not to say that living with my parents is a bad thing, it's just we really wanted our own space and wanted a place for our own. So we saved for a couple of years, and fortunately enough, in 2016, we saved enough to buy ourselves a one-bedroom apartment in London. So we were very happy with it, and throughout the first couple of years, we lived as we wanted. We went on holiday when we wanted to, we would eat out whenever we could, and just enjoyed life. We wasn't really stressed out about saving money because we knew that by paying into our mortgage, we're actually saving in a way. But not to say we didn't put away a little bit each month, because we knew we needed to build up a contingency fund just in case of emergencies. Then a few years after that, when we've built up enough of a contingency fund, we had a sum of money sat in my savings account. Now, my savings account isn't the best because it really wasn't giving me any interest at all. In fact, it was so little that it didn't move the dial in terms of increasing my wealth. This was when I realized I needed to do something with my money to be able to grow my wealth. This was when I realized I wish someone had shown me what I'm about to show you in the next few minutes. So sit back, grab yourself a brew, and let's get technical.
The reason why we're talking about saving versus paying off your mortgage versus investing is because of something called inflation. And by doing one of these three things, you can help protect yourself from inflation. Inflation is the increase in price for a basket of goods over a period of time. So for instance, a loaf of bread which might have cost £1 a year ago might cost £1.02 today. Now this is quite prevalent if you look at petrol prices now, which are at close to £1.40 to £1.50 per litre. I remember back in the summer of 2020, petrol prices were closer to £1.10 per litre. So what this essentially means is if you had £1 today, it will be worth slightly less a year later. So you can see from December 2017, the annual inflation rate has been between about 1% to about 2.5%. This means that for every £1 that I had in December 2016, I need £1.11 to have the same buying power. I've been saving on average £250 a month, which is about £3,000 a year. So cumulatively, over the 5 years, I have saved £15,000. I have a savings account with my bank that pays an AER, which is the annual equivalent rate of 0.05%. The interest on my account is paid monthly. So if I put £250 into my savings account each month, at the end of the 5 years, I will only have £18.45 in interest. This means that over the 5 years, I've only gained 0.12%. In fact, the gains are so small that £1 in 2016 is still £1 today. So how much interest do I save if I pay down my mortgage? So this is what the numbers look like if I just make my monthly mortgage payments, so without any overpayments each month. The important thing to note here is the interest payments for the year, which started at £4,442 at the end of December 2017 and reduces to £3,881 by the end of 2021. So if I didn't put £250 into my savings account each month, but put it towards paying off my mortgage quicker, the interest payments that I pay year on year decreases at a much faster pace than if I didn't make overpayments above and beyond my standard payments. So with the additional repayments, over the 5 years I actually saved 3.78% in interest. So for every £1 that I had at the end of 2016, I now have £1.04, which is gained through saving on interest. This is much less than what you lose through inflation, but it's still a lot more than what you'd gain from putting your money into a savings account. After learning that putting money into my savings account or paying off my mortgage quicker actually left me below inflation, it's safe to say this is what I didn't do. Being based in the UK, I first looked at investing into the FTSE 100. This is an index of the 100 biggest companies in the UK and can be considered one of the safer ways of getting into the stock market. So I picked an ETF, an exchange traded fund, which tracked the FTSE 100. But as you can see here, actually over the last 5 years, the FTSE has been relatively flat. In fact, in 2018 and in 2020, I would have been down in my position. And over the 5 years, we would actually be 3.3% up if I were to invest my savings into the FTSE 100. So this means every £1 that I had in 2016, I only have £1.03. Again, I might as well just pay off my mortgage because that comes with less risk. Of course, there are other forms of investments, like the S&P 500, which is a stock market index tracking the performance of the 500 largest companies listed on the stock exchange in the US. But in order to invest in the S&P, you need to exchange your pounds for US dollars, i.e. there will be a level of currency risk involved. So this is something you might need to consider if you need to convert currency, because if there's hyperinflation with the US dollar, your investment will be worth less in pounds. But let's say we took our £3,000 in saving and converted that into US dollars, which gets us about $3,800 to about $4,000. And at the end of each year, we invested into the S&P 500. This means that over the 5 years, our investment would have grown 46.8%. So now, for every £1 that we had in 2016, we have £1.47. Now this growth is much more meaningful to tackle the 11% inflation over the 5 years. Furthermore, if we were to put our money into the Nasdaq, which is an index weighted towards IT companies, the growth over the 5 years would have been 75%. And this is where I'm kicking myself, because it's inevitable that we'll all be driving electric cars in the near future. And if I had invested my money into Tesla, my £1 in 2016 would be over £10 today. That's 10x on my investment. Now it's probably a good time to note that the numbers that I've used here for December 2021 were the highest prices that we've seen during the year. Another hot investment that a lot of people have spoken about in 2021 is Bitcoin. So even if you put in all your savings into Bitcoin from 2016, the return on your investment is only 7 times, which is less than the 10 times you get from Tesla. So this last table summarizes what we've been talking about. Now before I transition to my conclusion, I'll leave this up on screen for a couple of seconds for you to digest.
So looking at the numbers here, I think in order to beat inflation, you have to do something with your money. However, I think the moral of the story isn't go put all your money into Bitcoin or stocks. I think the moral of the story is you really need to do what's right for you at your stage in life. So for instance, early on when I was saving for a house, I feel it was a bit too much risk for me to invest in stocks and shares. However, if you did, you could have saved quicker, but that was too much risk. I feel like it's only now that I'm more stable and I have my own home, I feel I can risk a little more. Now I think the purpose of this video isn't to say, look, you should definitely invest in, this is what you should invest in, but hopefully I've given you some food for thought to say, well actually, where is my money going and what level of yield can I make through each strategy? I hope you found this video useful, and please like and subscribe if you want more content similar to this.